Right. Welcome to our third in the series of Product Pulse. And today we're going to be talking about mastering product market fit. Now, this is a really interesting one because it's not just about the initial stages. Today we're very lucky to have Alex from Verb Ventures, who is a late seed to Series A investor. I'm going to let Alex do a proper introduction of himself later. But this is the reason we're doing it with this slightly later stage from the previous ones that we've done is to really show that once people are investing in this later stage, you really do have to have product market fit. Otherwise, these guys aren't going to be interested at all. So we're really trying to nail down exactly what product market fit not means just to us as say product builders or founders, but what it means to investors who are putting the capital in. So this is what we're going to be talking about today. I'm going to let Alex do a little introduction for himself. Today, let's talk about what we're going to be talking about. And this is going to be, a very loose running order. It's just going to be a, general chat. And yeah, we're just going to let Alex talk really. So Alex, without further ado, if you wouldn't mind introducing yourself, that would be fantastic.
Well, yeah, lovely intro. Thank you so much. So, well, we'll keep it quick about myself. So, principal with Verb Ventures.
Take as long as you like.
Yeah, okay. As John said, so indeed we are late seed to Series A investor. So we occasionally can do a little bit earlier, but normally starts. So we see ourselves more or less as an early scaling investor. So the investor which steps in when company already have some traction, found indeed product market fit, and what we do is we help in many different ways to scale this to scale this and make it effective business. One more probably important thing to say about us is, unlike many VCs out there, not saying all, but many, we are not really after super quick venture capital growth rates and stuff like that. We are after sustainable businesses. And so to say, strategy-wise, we generally very much disregard spray and pray strategy. So we believe it's wrong in multiple ways to say, can refer to a number of articles from different VCs, but you all know that game. When VCs are saying, you know what, we're investing in hundreds of startups. Out of those hundreds, we hope for one, two, maybe three to be successful and to compensate on the losses of others. So that's not what we do, and I believe it's just simply wrong strategy. Not going into super deep details, I'll just say that from investor perspective, it's, in my opinion, it means that investor doesn't know what they do and where they invest and don't want to spend enough of time or efforts trying to understand and help and so on. From a startup perspective, it means that investor you're taking money with such strategy, won't be interested to help you out as much as investor with more focused and concentrated strategy would, and B, such investor would be pushing you as a founder to kind of blitz scale or to grow faster, to, I would say, give away or don't care that much about efficiency, about unit economics, about stuff like that, but care about demonstrating quick revenue growth, which is not always ideal solution for the business in my view. So that's probably important element of a strategy. The rest, another thing to say is that we love and focus actually on B2B platforms. So not specifically, we can do wider, we can do, of course, as any VCs, we can do SaaS and stuff like that. But where our passion is, I would say, B2B marketplaces, wider platforms with SaaS components, without SaaS components, and so on. So on that side, I'm probably a little bit more knowledgeable about B2B businesses and I would say in principle paths of B2B business development. However, of course, we do have some B2C portfolios, and working across, throughout our career, working with lots of B2C startups as well. So and lots of principles are generally the same. So happy to talk about it as well.
Okay,
Yeah,
cool. So just off the bat of that, before we get into the actual product market fit, I think just I've picked up on a couple of things that you said there, and one of them was a sustainable business.
yeah,
Now, when you're talking about a sustainable business, I'm assuming you're not talking about the green credentials. You're talking about from a
yeah,
commercial perspective. So, could you just give us a top level overview of what you mean by when you talk about a sustainable business?
yeah, absolutely. So probably core and key here would be unit economics, right? So what do I mean under unit economics is obviously, let me give you an example. It's a very well-known case study when Get the taxi company, right?
Yep.
Multi-billion dollars now, been scaling in Europe. Or another example would be Getir, who is food delivery, like
Yep.
super quick food delivery company as well. So in both cases, they've been scaling on the assumption that in order for them to get, I'm simplifying obviously, but anyway, in order for them to get larger market share, what they need to do is they need to scale at negative unit economics, meaning that Get been paying to drivers effectively, been charging clients less than paying to drivers, and
Mhm.
Getir been losing money on each warehouse. They've been calculating unit economics on warehouse basis, and again, on average warehouse, to make a warehouse profitable, they would need to achieve like some crazy number of units per month or per day using this particular warehouse. So like getting deliveries from this particular warehouse. And in both cases, it means that company will be effectively burning money. So the larger company becomes, the more money it burns, which
Yeah.
is kind of based on the assumption and based on the logic that at some point of time they will win such big market share that it will allow them to kind of compensate on that. Well, I mean, it's one of the possible ways to develop the business, but when I'm saying sustainable business, I'm actually meaning the opposite. I'm meaning the business which effectively makes money from ideally day one, as simple as that, right? I don't mean
Mhm.
makes money net income wise. I mean, makes money unit economics wise. So what it simplifies to product or service you're producing, you're selling with some gross margin at least,
Yeah.
including calculation of customer acquisition cost.
And
Now,
you see acquisition costs as well. Yeah. So you're
yeah,
in a positive from
yeah,
including acquisition costs. Yeah.
yeah. Now there is one more kind of tricky element here. So how we calculate LTV, right? So how we calculate lifetime value of a customer, and
Yeah.
on this front, so we would normally be trying to. That's I would say one of the key metrics we'll be looking at when making investment decision, and we'll be trying to dive into the details of the calculation, the underlying data, and so on. But ultimately, I would say that again, depending on business type, but ultimately, business needs to have good retention versus customer acquisition cost in order for and have sustainable margin, especially in
Hmm.
B2B businesses. Margin can and platforms with whom we are working lots of time. Margins can be a problem and an issue. So you would all pretty often see a marketplace charging like 1 or 2% commission and spending crazy money on acquisition of a customer, which will end up in not sustainable business again, right? So easier to
Yeah.
give you example of non-sustainable businesses, because as an opposite to it, I would say that good business, in my view, should be able to at some point become independent of VC money, right? So
Hmm.
ideal pitch that I would hear from founder would say, yeah, you know, I mean, I'm actually not that far from profitability. I'm not profitable because I'm spending some money on marketing and I'm having slightly larger teams than now, but I'm not burning like millions a day. And if you are not investing, if I'm not finding the money, what I'm going to do is I'm going to increase my revenue by like additional 20%, slightly optimize the business, and I'll be profitable.
Yeah.
Uh,
Actually, on that point, before I forget it, so you mentioned sort of profitability from day one and sort of independent of VC money, being able to kind of sustain without the VCs. Um, how do I, as a founder and a business owner, decide whether VC is right for me? Because if, let's say I have got a B2B play and I've managed to maybe use some personal savings, or done a friends and family or something like that, and I've built a product and actually I'm generating revenue.
Yeah.
Why do I need VCs? You know, how should I decide whether VC is right for me just as much as,
Yeah,
I'm
that's
right for VCs?
yeah, that's a wonderful question, John, because you see the beauty of it, right? So, if you have all that, what VCs can do, it becomes from a question like, "Hey guys, I need your help to save my business and grow." It becomes
Yep.
it becomes a conversation of like, "Okay, let's sit down and look what we can do for each other. How you can help me, what value you can bring, and how you can make me go faster." In order
Yep.
for me to be able to explain to you why do you need to take my money, right? Why you value like in the end of the day, why you will make more money exiting from the business funded by us and in like 3, 5, 7 whatever years versus just scaling on your own. And the answer to your question is we can help you to accelerate the growth with
Yep.
financial resources, with network, with value add, and actually on the value side, and I hope we'll cover this a little bit today. I'm very much pushing all the time on analysis and kind of data-driven decision making, I would say. So on the collection of the data, collection of the user data, collection of all sorts of data, analysis of the data, making decisions based on that rather than on like gut and feelings that probably this one client is right for me, right? So
Yep.
what we can, why it might be beneficial for you. I'm not saying always you should, but why it might be beneficial for you to take the money of this is, well, because you would have more legs budget to scale, to experiment and to try. You will have most likely will end up growing faster and better in terms of both actually revenue and value of your business in terms of like valuation. And that's one of the options and one of the paths for you as a founder to develop your business. But I'm not saying, and I'm kind of insisting on the fact that good business, even you see, even VC funded good business should be viable business on its own, right? So and it makes it a beautiful partnership. So you see, I'm in principle, I genuinely believe that VCs should be partners rather than like investors who are giving money,
Love that.
sitting tight and not doing much and just receiving some sort of reports from you on a quarterly basis, right?
Yeah.
It's I mean, there are lots of VCs like that out there, and it's existing market working model, but it's just not us probably, and not right thing to do in my opinion in principle. But you see, it's
You're the good guys.
yeah. Thank you. Yeah, again, answering your question, I would say that ultimately, yeah, it's just another opportunity for you to go along with us, to partner and to achieve better results.
Yeah.
Provided that again, you see, you would have, say, much better negotiation position. You would have much better, not only in terms of like valuation stuff, but also in terms of everything. Negotiation position with us, negotiation position with client, negotiation position with anyone, and it
Yeah.
puts you in much better place mentally as well. So
Mhm.
I can tell from experience how different founders who feel that they achieve some certain like kind of inflection point where their business is working well enough on their own, on its own, they much more confident in the way they do things and the way they try new things, right? So it also effectively it gives you freedom to experiment much more and much more relaxed rather than in a situation where you are like completely reliant on the VC money.
Yeah.
That's yeah, and I mean it's good from multiple points of view, and for us as a VCs, again, it's not probably the super standard thing you would hear from a VC, but for us, we won't be pushing you to grow like multiple X year over year. Why is it? Because effectively neither us nor you need it. So if we look into, I would say into this journey in a little bit longer term, what we will see is that it's much more important to, I mean, keep your head above the water, and no matter what's happening out there, and to keep growing and developing businesses. Yeah, okay, with lower pace. Yeah, okay, maybe without like, I mean, skyrocketing growth and stuff like that, but keep doing it. And in horizon of like, say in 5 years, you'll find yourself in a great position with a business generating like a couple tens of millions per month probably, which is, I mean, a large amount of money anyway. And line of potential acquires for a couple hundred millions of from corporate point of view, and you'll be one to choose like, yeah, okay, whether I would like to be sold to sell my business at this point, or I would like to keep developing it and I mean achieve IPO or something. So
Okay, so we're gonna take a step back then. I've decided that we would like to raise capital, and the sort of topic of this webinar is kind of around the product market fit.
yes,
And so we've got a little bit of revenue. We potentially have positive unit economics, but can you break down a little bit what product market fit means to you as a late late seed to Series A investor means, and what kind of metrics specifically you would look for?
yeah, okay. So to answer that, I would first probably separate B2B versus B2C, right? Because it's very much
Sure.
different scenarios. Talking of B2B, so in both cases, product market fit obviously means number of customers, some revenue, some customers, and and that's it. But now devil is in the details, right? Because say you have B2B business with one large client making you your monthly budget or quarterly budget, whatever, and you have couple of smaller clients. Is it good enough for product market fit? Well, depends actually. Sometimes it does, rarely, but sometimes even that can be product market fit, right? Now, yeah, sorry. In If we're speaking of B2B, product market fit would be effectively testing of your business model, right? So what do you need to demonstrate with that? Is that your pricing model, your product, and everything is working as you expect it to be working. So when you're saying, yeah, okay, I am software business, that's my subscription. I'm having like 5 plans of subscriptions, with the enterprise plan, say, being different from starter plan by A, B, C, and D. And I'm effectively, have number of underlying hypotheses and assumptions there about the clients. What do I mean? You have an underlying assumption that that there are larger clients who would be genuinely interesting and ready to pay amount of money you're charging for enterprise plan. B,
Yep.
those customers would be interested in the features you have in enterprise plan versus like simple easy plan, and they will be ready to overpay for it and step in, and things like that. So what would be product market fit for that? Any reasonable way to demonstrate that, yes, there are clients like that, yes, they're paying, yes, I've tested it, yes, it works as expected. It can be, so meaning that for larger
How many clients? Say it's on the enterprise level. How many clients?
well,
1, 5, 10, 100?
Well, no, definitely not. So I would say it can start like early product market fit can start as early as like 5 to 10 clients if we're
Yep.
speaking of like larger enterprise clients. Because again, why? It's very logical if you look at how those businesses develop. Because I mean, B2B sales cycle is super long, right? It's depending on the product, but I would very rarely see a sales cycle of less than half a year, less than
Yep.
6. So it would be crazy for me as a VC to require from a founder to at late seed stage again, or like even seed stage, even Series A stage, to come to me with like hundreds of clients, each of whom been through the funnel for like 6 months. If we just simply put it together, like in a Excel spreadsheet, we'll get to the point that such business would be probably like Series D stage or Series B stage, something like far away from market fit. Now, when we're speaking of smaller clients, what is it? Well, I mean, again, case by case, slightly depend, but normally it would be larger number of customers, right? So maybe 10, maybe 15 smaller, let's call it SME customers, right?
Yeah.
Again, probably few important elements. Same logic goes to B2C, just more customers again on each type of product or type of subscription or whatever is in there. But few probably important things. Thing number one, LOIs doesn't count. Thing number two, freemium doesn't count. And any sort of free versions, free tests, free trials, free products. I mean, there is a huge gap in between offering something to the clients for free versus selling it to clients for $1.
Oh yeah. I always say that validation comes in the form of entering credit card details.
Yeah, exactly. I mean, people will tell you, yes, we love your, again, it's
Yeah,
very,
love it.
yeah, very common in B2B business, right? We love your product. It's so wonderful. It's so helpful. But mate, we have such a long decision-making process on our end. Can we have a free trial because for like just a month? And if you're coming with it to me as an investor, right? I know the background story from on your client side. I mean, I don't know it for sure, but I can guess. And in 99% of cases, it most likely would be correct. So again, yes, free any sort of free stuff doesn't work. I'm not saying it's bad. I'm not saying you shouldn't do free trials with your clients, but I'm just saying that it's not sufficient to be called product market fit. And also, I would genuinely be up for companies not relying. You see, I'll need to do a small step back here. Sorry about it. Right, minute. Yeah. See, it's very common mistake, I would say. I see across the industry that founders tend to kind of start chasing one large client, one large contract or whatsoever, or few large contracts at the early days. So founders would see great potential there, right? So they let's make up an example. Say we are speaking of games industry, and you happen to came across an NVIDIA who happen to be interested in the product you're offering to them, and you as a founder would have very kind of challenging choice whether trying to land them as a customer to your core product versus kind of adjusting your product to their needs. And pretty often founders would go second route because yes, that's NVIDIA. Yes, they are promising me millions and millions, and everything is going to fly just on this one. And again, as a founder, if you would come to me as a VC saying, hey, I have one contract with NVIDIA with whom I've been working for the past year, and on top of that, I have two small clients. What I would be concerned about and what I'd be looking in is whether effectively you've managed to sell your product to NVIDIA versus you've managed to build a product for NVIDIA to meet their needs. And if it's second,
so does this come down to understanding your target client as well then? Like, so does that fit into a product market fit as actually knowing my customer and knowing who I'm building this product for and who the ideal client is?
Definitely. And well, I mean, that's kind of, that's kind of all elements to the same equation, right? So who are my customers? What's my product? How am I pricing my product? what margins are there. So long story short, what product market fit in my view is summary and test of the whole supply chain of your business from the very beginning to the very end. And very beginning, I mean, especially for tech-driven businesses, it's very important to understand that, I would say, to not get deviated too much in terms of your product, not to do features for the clients, I mean, of course you need to take on board customer feedback, of course you do.
Yes.
But at the same time, you need to maintain what's your product is. And instead of changing it every time for every larger client or more, interested client, more engaged client, whatever, what you need to do is you need to make sure that you are developing product for everyone, right? That you are taking taking their feedback on board versus adjusting it for the needs of specific customers. And that sometimes you need to push back on this feedback. You need to explain that, okay, guys, probably you need to be ready to, I would say, pass on some opportunities which might be coming your way from large clients. Again, but yeah, so ultimately,
that's really important. You've given me an idea for our next webinar, actually, because we can talk about the roadmap and how you prioritize feedback and when to say no and all that sort of stuff. But that's a slightly more in-depth conversation. But I get it but then, because I think understanding the ideal customer kind of feeds into that slightly, because if you don't know your ideal customer, then you don't know whether the feedback is valid or not, because the feedback might be coming from someone who isn't actually your ideal customer, and you end up changing your product and wasting money and going around in circles. And so like you say, it does all feed in together.
Yeah. So, I mean, as simple as that. So as an investor, as a VC, what they want to hear is a ideal perfect pitch sounds simply like that. Yeah, you know what? We found that's what we do. That's how we do it. We know how we do it. We don't have issues there. We know how to produce the product or the service or whatever. Now, second element, our customers are ABC, like definition, who are they? There are 200 companies like that in the UK only. We managed to get to 5 of them, all 5 converted into clients, 3 already paying, 2 are in pilot stages. And we need your money to hire a few more people and get to the next 195 customers in the UK. And at the next stage, we'll go out of the UK to whatever market you're targeting. I mean, I'm simplified it to the very basics, but in the nutshell, right? So you see, I'm always walking around. You ask me like, what's product market fit? Is it 5 customers or 6 customers? And I'm not answering you this question because you see, it's very much depending on the.
Of course it is.
Yes, type of the customer.
So then let's change the question slightly and ask, what steps can I take for my business to try and achieve product market fit? What are the best routes to achieve that? What are the practical steps that I can take to ensure that I'm giving myself the best chance?
Yeah. Okay. So few things. As you absolutely correctly highlighted, you need to define your customer and focus only on core customers, especially in early days. And it would save you, I mean, hours and days and months of time and like probably not millions, but hundreds of pounds just because you won't be changing your product too much. So again, focus on core customers, define who it is, focus on it, and test the product for the core customers, right? Still try to be adaptive and try not to reimagine the industry or I would say, try not to reimagine the industry where you are not comfortable in. Okay. Let me put it this way. Try to fit the industry needs, right? So not try to explain to everyone around how to do things better. Instead of that, try to solve their problem. So not try to. It's again a very common mistake to create a product and think that everyone out there would love that. So instead of it, base what you do on the customer's feedback. So it's very hard balance to find, and it's probably one of the elements of the kind of entrepreneurship acumen in principle, is finding this balance in between taking on board customers' feedback and saying no to customers, right? Saying no to their to what they want and what they're trying to achieve, right? So anyway, define clients, focus on that, try to commercialize as early as you can. It's not again, it's not necessarily should be millions from day one, right? You can try to be very creative with your pricing, with your discounts. You can keep increasing it as you go and so on, but try to sell it from as early as you can. Why? Because the moment, as you again absolutely correctly said, the moment you are asking a client to enter credit card details, it changes everything. Because
but also on that one is the lifetime value just is that important as well. You know, the engagement rate. So yes, I've entered my credit card details, but then if I bounce a month later, then you know, is that product market fit? Maybe not.
It's probably not, but nevertheless, as long as customer signed up, right, you already have much more information and data to analyze and to make decisions based on. So what do I mean? Even in the case you're describing, you had few customers signed up and then they bounced off in 2 months' time. You will have lots of things to think about. Why they did bounced off, what they missed, what they used on the platform, what they didn't use on the platform, what was their feedback, and so on. So it will allow you to let's simplify it to that way. Look at your early customers as early testers of a product who, however, keep in mind that part of this testing should always be paying something your way. Not like
So in terms of like, let's say I've got a paid user, how do you guys feel about like user interviews and talking to our customers? How important is that to you as an investor and or me building building a product and trying to achieve product market fit? I'm assuming incredibly important.
Yes. Sorry, John, it's slightly like, can you go again with the beginning of the question?
So yeah, no, sorry. So in terms of I've got a paying customer.
Yeah.
And I user interviews, how important is that? And understanding, the feedback from my users, how many of these should I be doing? How often? That sort of thing. And this is the last question from me, by the way, before I open it up to Q&A to everybody else.
Okay. Well, again, in principle depends, but yes, like general answer, yes, you should be definitely doing customer interview. I'm not probably best product guy. However, again, from my experience, so you should be doing different interviews at early stage, right? So first you're gathering customer feedback and trying to understand and build up your product effectively. So first thing, you're trying to understand the customer needs. Doing first iteration of a product. Then you're trying to get a feedback. Effectively, what you're answering to yourself is, did I understood clients' pains correctly? Did I define my core clients correctly? Did I have done it for them? Is it what they actually need? So you make people use your platform. You make them pay you $1, but not millions. You make them give you more feedback. Now, challenging part comes in, where you need to balance again, as we just discussed, where you need to balance taking this feedback on board versus not taking this feedback on board. In order for you to be able to balance it correctly, what you need to do is you need sufficient amount of feedback. So what I mean here, don't let one large customer define your thinking, right? What you need to do is you need to talk, if you're targeting customers like enterprise level customers, you need like 3, 4, 5 enterprise customers. It won't be working without it. Without it, you will end up building something for the enterprise customer who is giving you this feedback. which is, I mean, can be good business, but definitely not a VC business, right? So it's just,
Yeah.
yeah,
Well, then you're just a software development company as opposed to a productized business.
exactly, yeah. So now, if we are speaking of more like customer businesses, like more B2C businesses, there are another layer to that, which is, so yeah, probably one more important thing to say is very much different customer acquisition cost and very much different approach to sales, obviously, right? So in one case, you're optimizing digital channels and digital acquisition channels. You're optimizing your target audience. You're optimizing your effectively digital marketing, right? And that's what you're focusing on. And like 40%, 30%, like one third probably of product market fit would be defining, also defining acquisition channels. And especially in B2C businesses, right? Defining, understanding, getting to a consistable and reliable amount data in terms of like, again, customer acquisition costs, spends, retention, usage on the platform and stuff like that. Versus B2B, where your customer acquisition cost could be very high, depending on how you calculate it, but normally your customer acquisition cost is the salary of founder and later down the line of founder plus sales team doing direct sales to the customers and having meetings, exchanging emails and so on. So it's like time spent effectively, which is different. So again, going back to a question on the customer feedback. On B2C businesses, yes, you need to do ideally regular. Won't be trying to guess like it should be like monthly or quarterly, whatever. But you should be regular doing customer service. You should be calculating like NPS and stuff like that. You should be. I would also recommend there are pretty few free or almost free to use platforms which allow you to collect the data. I would
Exactly.
probably name like Metaverse, right? So there are tens of this. So
Yeah.
I would strongly recommend using some platform like that from a very very early days. It's really seems to be. You see, it seems to be time spent versus like unnecessary time spent, and especially in the early days. You're thinking like, yeah, come on, I have like 10 customers. I don't need to spend lots of time analyzing their data. Well, actually, you do need. Actually, what you need to do is you need to build up very detailed and granular ways to collect your data. And on the data, let me define it. I mean, how customers behave on your platform, how customers stay, I mean, buy, stay, use, leave, and you need as many data points as you can in each and every stage of this chain, right? So, yes, you need to do customer reporting. You need to analysis of customer feedback. You need to run campaigns and collect feedback. Ideally, you need to collect as many data as you can on your own to analyze it and to make decisions based on that. And if it's B2C, it's one set of data. If it's B2B, it's a little bit different set of data. Yeah.
Cool. Okay. That's great, Alex. Thank you. I'm gonna open it up to the questions now. So I've got one here from Mark Batty, and this is from what I can see more around figuring out whether you don't have product market fit. But I'm going to read it out. Mark, hey Mark, I know Mark. I would assume a business, particularly B2B, cannot say they do have PMF during early adoption. However, they could correctly say they do not have product market fit if engagement retention decreases with early adopters. Any thoughts related to this? E.g., you can correctly confirm you do not have PMF and you have to adapt feedback via feedback, etc. Thoughts on this?
I'll give you one great example here, like absolute life example. If you don't mind, I won't be telling. Yeah, I'll change a couple of names, not to hurt the company, right? So we had company in the portfolio, still have it, wonderful one, and I had very long relationships with them personally. So I met the company at one of the acceleration programs as a mentor. back then they were clearly like B2C focused business. I've told them, hey guys, you need to try B2B. We discussed it. I explained what they need to do, what I assume they need to be trying, how to kind of shift their business towards a little bit of B2B. I said, yeah, we definitely should do it. Went away. In a year's time, we're catching up. They're saying me, you know what? We now have product market fit in B2B. Yes, we had it in B2C all along, but now we have it in B2B. I'm going, interesting. What is that? I'm going, we have a large client, neobank. I won't be naming it, but large neobank. We have large neobank partnering with us. Here is our partnership agreement. I mean, we are flying. They're promising us. It was something like, so if we calculated in like annual revenue, it was like 2 point something mil annual revenue from this client. Well, like wonderful business. Give us the money. I'm going, yeah, okay, let's see. While we've been doing closing this deal, turns out that Revolut is like, yeah, you know what? We started to use it. I named it Revolut. Anyway, yeah. So Revolut started to use it. Like, yeah, we're partnering, we're working, and then kind of something changes on their end. Maybe team changes, maybe interest changes, and the activity goes down, the engagement goes down. They still kind of use it, but not as actively, and far from targets and expected volumes they've been promising. So what we ended up doing with the company, explaining to them like guys, it's not sustainable to rely here, right? What we need to do instead, we need to discover more customer segments. We need to go slightly smaller customers. Try to engage with those. Let's diversify the client base and so on. We did it now, and the beauty is that like half a year, probably 2 years ago, they've been coming to Revolut saying, "Hey guys, you are our biggest, best, largest client. Please give us." Let's proceed with our contract. They've been almost begging for the contract to Revolut. Now they're coming to them and saying, you know what? We're actually working with 10 of your competitors. We're actually also working with lots of other customers. So, I mean, guys, we no longer can be asked to modify our solution for your needs. So if you want to use it, here is the link. I mean, you can integrate, you can use. If you don't, I mean, we don't care. And guess what? Obviously, it turns around the conversation. Ups and downs. You now have it in both ways. So then, going back to the question, like I gave an example, but what this example shows? It shows that you can fool a VC, right? You can tell a VC, I have a product market fit, whereas you don't, and VC can make a mistake and believe you, don't believe, or whatever. But don't fool yourself. That's probably my 5 cents, right? So you need to be very cautious about the stuff as a founder and as a business owner. So you need to understand that, again, few large clients doesn't mean that the fact that client is telling you today, yeah, we're going to use your solution for a million years going forward, doesn't mean anything. Like literally anything. They can stop using you tomorrow because of the changes in the team, because of the changes in their business, because of anything. So what you need to be very cautious and very confident in that you're building business which is not reliant on a single single group of customers, which can be used by the industry, by wider, but you have ability to diversify client base. Otherwise, you end up as a product company for one particular client. Maybe we'll do a partnership with them. Maybe we'll be acquired by them for pennies, but it's probably not the business you're after, not the skill you're looking to build, right? So
Great. Okay, so we've got time for one last question, and this is from Rhoda, and she has a business called Give.app. And her question is, after asserting product market fit, what's the best strategy to raise funding if you've built some traction, maybe not financially per se, but people traction? So we did cover this slightly earlier. And then the follow-up question based on this is, do I need to find a way to build financial traction before I get reasonable funding?
Okay. Yes, you generally do. I mean, it's always there are a few examples out there. Say AI company, ex-OpenAI guys who raised 100 million round pre-seed round, $100 million at pre-seed, no products, company formed like yesterday, right? So
Yeah.
yeah, there are some examples like that. But they are very, very, very one-off rare cases of I mean, almost each of them has some underlying reasoning behind where investors, founders, and it was with like pure pre-seed for 100 mil. And and if we leave such examples outside of the scope, if we would talk about like more to the ground businesses, answer to this question is very straightforward actually. The more financial traction you have, the better valuation you will get. As simple as that. So
Yeah, and actually, I'll just add a tiny bit of context. We're looking at sort of pre-seed, seed here for Radford. She says she's raised some pre-seed, but it wasn't enough to build an MVP. So I don't know if that adds context, but I think the answer is still going to be the same, right?
yeah, so I would generally say that your first round you don't need any commercial traction. Now, depending probably so with some exceptions, right? There are industries which require longer product development, longer research and stuff like that. So if we are not, there are lots of like capital intensive industries, time intensive industries. I get it, right? If it's not the case here, so I just don't know the business we're talking about. But if it's not the case, by the next round, so after probably first 1-2 rounds, which is like accelerators, which is friends and family, which is maybe angels, to get institutional money, to get institutional VCs in principle, what you would like to do is you would like to see at least early traction, at least a few sales. You see, it's just simple that it will put you in a different bracket, right? So from pre-revenue startup, it will put you into bracket of early stage revenue startup. And it's actually, it opens lots of doors for you. It opens, there are lots of VCs out there who would tell you straight away, if you don't have revenue, don't knock on our door. We're not ready to invest per revenue. Just as simple as that. You will just, you won't pass the first screening. Whereas if you do have at least some revenue to show, you will pass the first screening. You will have a chance to convince even later stage VC that, I mean, you guys are missing out on an opportunity here. Yes, it's already you see, it will at minimum. I'm not even saying about the valuation and stuff like that. At minimum, it will open you lots of doors. So it will allow you to try to, as you see from my answers, each case is different. In each case, we are looking at particular business logic behind what you've done, and it's very hard for me to kind of say you need $1 million revenue annual, and you need 10 clients, 9 clients doesn't work, 10 clients is perfect. I mean, it's not real life example would be, right? So again, it will open you lots of doors and lots of conversations where you will be able potentially to convince investors that, guys, I have 5 investors. I don't know what you're thinking about. 5 clients. I don't know what you're thinking about it. But in my opinion, 5 clients is sufficient product market fit. And that's why. Why? Because I've tested everything in terms of pricing. I've tested everything in terms of product. They are all paying me money, doing the same, using the same product. It's all working, and I mean, super simple to go and scale. And other customers out there whom I'm targeting have roughly the similar profile as this 5. So I don't know why you guys need another 10. You would be missing out on an opportunity. You see, I'm always
perfect. And actually, so I pick up on that 5 customers thing because we've got time for one last question. We've got like three minutes or so before we wrap things up. And it's on the 5 paying customers thing because we've got a question from Sam here. PMF based on 5 to 10 paying customers. Is there an ideal time period for how long they've been a customer longer it goes, the harder to support / adapt without funding. Where is the perfect balance, if there is one?
Well, ideally, if you can show that I have probably a good answer for that, which is the following. You would be showing to investors calculations of lifetime value, right? That's what you'll be doing. If you can prove that at least one customer, or better more, but at least one customer actually achieved the values comparable to the LTV you're projecting. So how you calculate LTV? You're saying, I'm assuming I have very low churn rates. That's why I'm assuming like 10% churn rate. And based on that, I'm saying that customer will be with me for 2.5 years and will generate, I don't know, like $1 million LTV. So if you can show that there is at least one customer who generated you not $1 million LTV, but like 500K LTV, so like major part of the lifetime you're projecting. So like LTV will be always looking like that, right? It will be decreasing from time to time. So for your product, if you can show that there is a customer or group of customers who actually did paid you for probably a year, probably a little bit less, but some comparable to the LTV amounts. Let me put it this way. So like to say that when you are projecting LTV of 1 million and saying, you know what, my product market fit is 5 customers, each of whom paid me $500, not 500K, but $500. I mean, it doesn't sound like product market fit to me. Does it to you? Probably not as well.
Sure.
So
Yeah.
that's probably the balance you need to be looking. But again, VCs out there are not. I mean, we are from the same planet, right? So we understand the same issues you guys are going through, and I completely agree that yes, it's very hard to maintain. To maintain and support the customer without funding. That's not how it should be working. So proper VCs out there won't be asking you for something mental. They won't be asking you for inconsistent with the stage of your business traction, right? Because it's just wrong to do. So
right,
in principle, it should be consistent. But long story short, if you can prove your LTV calculation somehow, that's wonderful.
Amazing, cool. That was the last one, and that we've got feedback saying thank you guys, understood, thanks all, and actually a big thank you from me, Alex, because this has been really super informative. I think we could have gone on for another hour actually, and we've got quite a few bits that we can take away from this. But actually, don't forget everybody, we will circulate this, and actually our next product pass, and this is quite important and quite exciting, will be an in-person meetup in London somewhere. And actually, tentatively, Alex and his team have said that they're going to be there as well. We haven't got dates yet, but so look out for those. And we will have, the format is yet to be decided, but there's potentially going to be a Q&A or a speed pitch or something along these lines. It's going to be exciting. So look out for that, because that's going to be late September, early October, in-person meetup in London with VCs, angels, everybody, just getting everybody in the ecosystem in the mix. So look out for that. Yeah. But for now, thank you, Alex. This has been a really informative session. We really appreciate your time coming on, and thank you to everybody who's joined.
No, I mean, thank you for having me. That was a great pleasure for me. And I mean, if anything, you guys might ask John for our contacts. We're happy to chat. And one more thing I would tell you as a closing thought, that lots of VCs out there, including us, we all do love to build a longer term relationships. So it's absolutely normal, and there is nothing bad for you to knock on our door a little bit earlier. Yeah, you would likely to hear from me that probably a little bit early for us, but it's going to be a good starting point for our conversations, and I'm more than open to discuss and advise and talk about your business and problems. So don't hesitate to get in touch early. To myself or to other VCs out there, I'm hearing it from lots of peers in the industry. Everyone really keen to, you see, look at it very straightforward. What we are doing when we are sorry for holding us here.
No. This is really important because this is a really good piece of advice, actually.
Yeah, when we say giving you money, we are entering into partnership, which should be lasting for like at minimum 5-7 years. When you do that, you normally want to know the person and the business a little bit longer than like months or 2 months of due diligence process and decision making.
Right.
So get in touch, even if you guys a little bit earlier. Get in touch. That's
get out there, people. Get out there. Get selling. Get relationship building.
Yeah, and yeah.
Amazing.
Have a great day.
That's a really nice. That's a really nice takeaway, actually, because it's not specifically related to the product market fit, but it's more about actually building those relationships. Because a lot of times people think that, oh, I'm going to start my fundraising process in 3 months' time, I'm going to have some money. It doesn't happen like that. So yeah, that's a really nice takeaway, actually. I love that.
Yeah, all of us.
Thank you.
No, thank you for having
Bye,
me.
everyone. Thanks for joining. Thanks, everyone. Bye bye.